Scene script. Picture a nation where the earnings of most households are declining significantly. A land where the rate of inflation outpaces the rate of pay increases. A place where the once reliable government subsidies dwindle, impacting household income. You're not imagining a dystopian future. This is the current state of the U.S. economy. Recent reports from the U.S. Census Bureau paint a sobering picture of the American economy. Over the past year, the earnings of most households have declined significantly when adjusted for inflation. This decline, a troubling 2.3% for households in the middle of the economic distribution, has affected all segments of the population. Men, women, married couples, single-headed households, full-time workers, and part-time workers. But what's causing this downward spiral? It's not a decrease in work effort or pay. Rather, the villain of the piece is inflation, which has been stealthily outpacing pay increases. This has resulted in a noticeable decrease in income, a reality that has not escaped the attention of Americans. And this perception has contributed to President Biden's poor rating for his management of the economy. The decline in household income in 2022 is part of a longer trend. Household income corrected for inflation has been falling since 2019. A brief respite in 2021 was due to government subsidies, but these subsidies dwindled in 2022, further impacting household income. After taxes, household income fell by a staggering 8.8% last year, with varying impacts on different racial and ethnic groups. Yet amidst all this gloom, there is a glimmer of hope. The rate of inflation for 2023 is expected to be lower, and wage increases have outpaced inflation in recent months. The impact of declining government subsidies will also be smaller in 2023, and the impact of economic legislation may begin to be felt by workers. If household incomes continue to increase, the public's perception of President Biden's economic management may improve. However, the future is uncertain. As the income of American households continues to fall, the question remains, is the worst really over, or is this just the beginning? A 1.4% decline in GDP, an 18% increase in the goods trade deficit, numbers that paint a bleak picture of the U.S. economy. But is it as bad as it seems? Let's unpack this. The first quarter of 2022 saw a 1.4% dip in the gross domestic product. This means that the total value of all goods and services produced within the country shrank slightly. It's a number that economists watch closely as a temperature check on the health of our economy. This downturn coincided with an 18% surge in the goods trade deficit. In simpler terms, we were importing considerably more goods than we were exporting. This imbalance can be a concern, as it might indicate a nation consuming more than it produces, a scenario that's unsustainable in the long run. But wait, there's more to the story. The GDP contraction and the widening trade deficit were not just arbitrary occurrences. They were largely influenced by a couple of external factors: the supply chain disruptions and the impact of Russia's invasion of Ukraine. Supply chain disruptions caused by the pandemic have been a global issue, affecting various sectors from tech to food. The US was not spared either. As for Russia's invasion of Ukraine, it created instability in the global market, affecting trade and subsequently the US economy. However, amidst these seemingly gloomy numbers, there are glimmers of hope. Consumer spending, which accounts for more than 2/3 of the US economy, actually increased by 2.7%. Business investment, another key component of the GDP, grew by a robust 9.2%. These positive trends suggest a potential recovery, indicating that the economy is resilient and capable of bouncing back. While these figures may sound alarming, they could be a temporary setback as the economy adjusts to new challenges, but only time will tell. A declining debt-to-GDP ratio, a sign of economic recovery, or just a temporary respite in a stormy economic climate? Let's delve into this. Analysts at Morgan Stanley have made some intriguing predictions regarding the fiscal deficit of the United States and the debt-to-GDP ratio. They project a swift decline in the U.S. fiscal deficit arising from COVID-19 spending, thanks to economic growth. In this context, the debt-to-GDP ratio is expected to decrease by 7 percentage points in 2022. This might sound like good news at first, providing a ray of hope amidst the economic turmoil. But are these projections a harbinger of true economic recovery, or merely a temporary pause in the economic storm that the U.S. is currently weathering? Economic growth is touted as the knight in shining armor that will reduce the deficit. But how sustainable is this growth? And more importantly, can it outpace the rate of inflation which has been eroding the earnings of U.S. households? Moreover, the analysts at Morgan Stanley emphasize that interest rates and net interest expenses hold more weight in determining the state of public finances than the debt to GDP ratio. This underlines the importance of monitoring these metrics in addition to the debt to GDP ratio. So even though the debt to GDP ratio is declining, it is not the sole indicator of economic health. It's like checking your pulse to assess your overall health. It can give you some information, but it's certainly not the whole picture. As the US economy continues to grapple with the effects of the pandemic, the debt to GDP ratio may offer a glimmer of hope. But whether this hope translates into real economic recovery remains to be seen.